Well, all right, then shall we get started? Oliver, this is going to be your show since you're the chair.
Yes,
So
thanks,
please take it
Paul.
away.
Well, thank you all for coming. Excited to have this session on machine learning and corporate finance. So let's get right into it with Ranik's paper.
Thank you. So can you unshare your screen, Haifeng, so I can share mine?
Okay.
Great. Let's see. Yeah, I suppose you can see my screen now?
Yeah.
Yeah, good. Okay, so thanks to the organizers for letting us present our work here, and thanks also to the chair, Dr. Oliver Binns, for being accepting to be a discussant after this presentation, and to all you good audience listening in on our work and what we're working on currently. So I'm going to present to you a paper we're working on called Bankruptcy Prediction of Privately Held SMEs using Feature Selection Methods. And my name is Ranik Ron Wallström, and I'm from the Norwegian University of Science and Technology. And this paper is in cooperation with Professor Florentina Paraskiv, who also is from the Norwegian University of Technology and Science and Technology, and as well as the University of St. Gallen. And it's also in cooperation with Professor Markus Schmidt from the University of St. Gallen. So models for company bankruptcy prediction are important for many actors, including banks and regulators. So banks, first of all, use such models, among other things, to make credit decisions, price credit spreads, and also to stress test their loan portfolios. Regulators, on the other hand, use such models, for example, for stress testing the current state of the financial markets, but also to do on-site supervision of banks. The choice of input variables for such bankruptcy prediction models are often ad hoc chosen. And the choice is also debated among many academics and practitioners. So in this study, we fill this gap by using alternative feature selection methods to derive these input variables from the data itself. So for doing that, we use all the annual financial statements of all privately held Norwegian SMEs from 2006 to 2014. And the reason for choosing privately held companies and SMEs is because such companies are heavily underrepresented in the existing literature. Indeed, the existing literature tend to focus on listed firms and larger corporates. They are also a significant proportion of the bank's loan portfolio, and they make up a large proportion of the economy. I'll also note that we have no missing values in the data. The data is the same data as the tax authorities in Norway use to calculate the taxes of all the companies. So no missing values. We have all the information the companies have indeed reported. From these annual financial statements, we derive 155 accounting-based input variables for each financial statement. And these 155 accounting-based input variables are identified in the existing literature. After deriving these 155 input variables from all these annual financial statements, we use feature selection methods to derive the set of input variables which is most appropriate. And in particular, we use three different feature selection methods, one within each of the groups of feature selection methods there are. So first of all, we use a filter method, which uses the Pearson correlation coefficient as the criterion. We use a wrapper method, which uses the IFFRS algorithm, and we use an embedded method. And as the embedded method, we have chosen the lasso method. We have also done our tests with the ridge regression and also different elastic nets, but in all cases, the lasso method performed the best. And the lasso method is within the logistic regression framework, meaning that on the left-hand side of this method, we have the logic of bankrupt or non-bankrupt. Then after this feature selection method, select appropriate sets of input variables, we test them in models using two different tools. And these tools are logistic regression, very interpretive, so-called statistical method, easy to interpret both the output and the coefficients. And we also test the input variable selected using models using artificial neural network. And in light of the previous paper, we also use a deep neural network. I think three hidden layers, and with 20 nodes in each. Okay, so further, we predict bankruptcy in a one-year perspective. In other words, for any financial statement for any year, we predict the probability of the bankruptcy of the underlying company until the next financial statement. And this is the practice most used by practitioners and academics, and it's also in accordance with the Basel III regulatory framework. In the Basel III regulatory framework, they also say that one should use this one-year perspective. Then we follow a six-fold cross-validation procedure where we also account for the time dimension by using a rolling window. So for each of the six folds, we use all financial statements from 3 subsequent years and to select the input variables, train the models, and evaluate the in-sample fit. And then we use the preceding year to evaluate the out-of-sample performance. And we make sure that there's no data leakage. Everything we do to kind of adapt the models is done using the 3 subsequent years, and we don't touch data in the last one. So this is done for 6 times, so we test our results across these 6 folds. And this is our first results. Here on the vertical axis, you see the out-of-sample AUC when we're using logistic regression. And AUC stands for the area under the receiver operator characteristic curve. And it has, in practice, a value between 0.5 and 1, where 1 is the better. So the higher value, the better model. And on the vertical axis here, we see the number of input variables in the sets. So first of all, we present the results of 5 different benchmarks. And these are the input variable sets used in the Altman model from 1968, the Altman and Sabato model from 2007, which is indeed adjusted for or derived or developed for SMEs in particular. We use also the input variables in the Toffler model and the input variables in the Smiewski model. And we also use the input variables in the Zebra model. And the Zebra model is the model developed by the Central Bank of Norway, which is currently also used by the financial regulatory authorities in Norway for stress testing banks and the financial market. And the reason for using also this Norway-specific model, or the input variables in this Norway-specific Zebra model, is because it's developed on the same type of data we are using in our analysis. So these benchmark models are shown in dots here. So you see, for example, the orange dot here is the Altman model from 1968. It shows a performance out of sample of about 78% of AUC. And it is here on the horizontal axis because it has 5 input variables in the variable set. So note also that we don't use the models themselves. For example, the Altman model is derived using discriminant analysis and so on. So we don't use the models, but only the input variables used in these popular models. Okay, the lines here show the results when using the input variables selected by the feature selection methods. And the reason why these are lines and not dots is because you predefined the number of input variables a feature selection method shall select before you actually use it. So here you see, for example, the orange one being the performance of the input variable selected by lasso method. It has this performance if only 1 input variable is selected, 2, 3, 4, and so on. So that's why they are drawn as lines. And finally, we have a red line here, which is the performance when just randomly selecting input variables. So first of all, we see that when we see on the red line and how far it is from the others, we see clearly that it do benefits to actually carefully select the input variables you use and not just randomly using someone. You should carefully select them. We also see that the best performance is given by the wrapper and lasso method, or the input variable selected by these methods. And we see that the Zebra model is not that far behind. It's actually, and this is as expected, since the Zebra model, after all, is developed on Norwegian data. So these are the results when we use logistic regression as a method. However, our results look pretty much similar. The plot looks almost exactly the same when instead using an artificial neural network. So our results here are very robust across both these methods. Okay, so this is the auto-sample performance for the different input variable subsets. Another thing which is important to evaluate when evaluating feature selection methods are their stability over time. In other words, their ability to select the same input variables across different times. And this is because it brings about more confidence in models if they kind of is consistent. Okay, so the stability of the variables selected by the feature selection methods is shown in this graph. So here again, we see on the horizontal axis the number of input variables in the set. And for the feature selection methods, we have lines here because you can predefine the number of input variables selected by the feature selection method before you use it. And now on the vertical axis, we have the number of unique input variables among those selected across these 6 different folds. So yes, and we also have 2 diagonal lines here. The red diagonal lines show the worst possible cases. In other words, when the feature selection methods select completely different input variables for each of the 6 folds. For example, if we let a feature selection method select 4 different input variables for each of the 6 folds, the worst possible case will be if it in total select 24 unique input variables, right? 4 times 6. So the red diagonal line is the worst possible cases. The green diagonal line is the best possible cases. In other words, cases when the feature selection methods show the same or selects the same input variables for each of the across each of the folds. Okay, so here we see that the input variables selected by the filter method and the lasso method are most stable across all the folds because we see they are closest to the green diagonal line. And in particular, we see that the lasso method is slightly more stable than the filter method. So when adding together the previous slide and this slide, we see that the lasso method performs overall better than the other feature selection methods because it is one of those with highest auto-sample performance, and it's also the one with one of those with the best stability. So we use the lasso method going forward to analyze and look deeper at the actual input variables it do select. And for this analysis, we look at the decreasing marginal increase in the auto-sample performance. And based on this, we see that 10 input variables is a good kind of a good choice when considering flexibility comparing to performance, right? Because if you include too many input variables, you will get a very flexible model, but you wouldn't get that much better model, and so thus you will end up with a less interpretable model. Okay, so we choose to look or analyze at the input variables selected by the lasso method when it selects 10 different input variables for each of the folds. And these are the input variables selected. In total, 12 unique input variables across these 6 folds. And we don't have time for details for all the input variables, but what's important to see here is that the lasso method selects input variables which are represented in 4 of the 5 main aspects of a company's financial profile. In other words, the lasso method select input variables representing liquidity, profitability, leverage, and solvency. However, not the 5th main aspect, activity. However, this is also in accordance with the revision of the Altman 1968 model, the revision of in the 90s, where the researchers concluded that activity indeed wasn't necessary for bankruptcy prediction and should be excluded because it was considered insignificant and also very industry sensitive. Further, we see that among these 12 selected input variables, we see many similarities with the Zebra model, which is expected because it is also developed using the same data. And these are the coefficients estimates for all the input variables selected by the lasso method. So for each year here, 2009, 10, 11, and so on, given in the columns, we see 10 coefficients for 10 selected input variables, and also a coefficient for the intercept. And this is the coefficients when the input variables are trained with logistic regression. So first of all, we see that the coefficients have signs as expected. For example, accounts payable to total assets have a positive coefficient, meaning that a higher value of this variable means a higher probability of default. So this is logical, right? Because if you owe a lot of money, you probably are higher risk at bankrupt compared to not owing a lot of money. Okay, so all the coefficients are, or all the signs of the coefficients are in accordance with our expectations, and they're also very stable across the years. We also find that all coefficient values are significant when deriving the C-scores from WALD statistics, which you see here in parentheses. Below all the input variables, we see here the in-sample performance given by AUC, the Brewer score, Ake information criterion, and McFadden's pseudo R-square. And we see that the in-sample performance is very good across all the years and also very stable. Similar with the auto-sample performance, it shows a good auto-sample performance, which is also stable across the years. So good, so far so good. We have seen that the lasso method gives the best input variables to use in bankruptcy prediction models, and we've seen how these input variables selected actually make a meaning economically when being used later. So far so good. However, there is one question remaining. So if you present this to a bank and the bank asks you, okay, you suggest this model configuration, it gives me 3% or 5% or 1% better AUC. What does it make? What's the difference for me? How much more money do I make on using all this money to implement this new model? Okay, so and this is something the statistical methods or statistical evaluation metrics have a hard time answering, because they have some drawbacks, and the main drawback is that they assume equal cost of different types of prediction errors. Okay, so if you're a bank and you want to predict the probability of a bankrupt of a potential customer, you can do two types of errors. So the first type of error you can do is to failly or incorrectly predict a company's bankruptcy. In other words, you predict that it will not go bankrupt, but it either way does. In this case, you lose a large portion of any granted loans. The second type of error you can do if you're a bank is to overestimate the probability of bankruptcy of non-bankrupting companies. In other words, you think the probability of bankruptcy for these good customers are artificially high. In this case, you will assign too high credit spreads to these good customers, and they will possibly get better offers from competitive banks, so you will lose out on any income. Okay, so number one here, you lose a large portion of any loans, but number two, you miss out on some income. And clearly, the cost of these errors are not the same, but the commonly used statistical metrics, which we have used so far, don't account for this. So we therefore propose to simulate a credit market. And this is, we're not the first to propose it. It's been elaborated around this technique in Journal of Banking and Finance for some years ago, but we extend it and use more or apply more real world data in our simulation. Okay, so for our simulation, we use the effective size of the whole Norwegian SME loan market. And this is found by deriving the amount each company wants to borrow from their financial statements, from all these financial statements we have from the whole country. Then we let there be 8 banks in this simulation. 3 of them are using using the input variables in from one of the feature selection methods respectively, while the 5 other banks are using the input variables in one of these benchmark subsets. Then they use these input variables these banks have. They use the input variables in a logistic regression model to calculate the probability of bankruptcy for each borrower, in other words, each company for each respectively year. And based on this probability for each bank, they make a credit decision. In other words, do they offer a bank loan or not to these customers? And then they do a credit pricing. And finally, the companies choose the bank giving the best credit spread. So much methodology in this simulation, which I don't have time for, but it's gone through in the paper for details. But just to conclude, the results looks like this. So here we see the profit in euro for each of these 8 banks in this simulated credit market. And clearly we can see that the bank using the input variables of the lasso method performs much better than the rest. And in particular, when you compare the lasso method with the wrapper method, we can see that a slightly better AUC from our previous slide yield a much higher profitability. And this we can also see when looking at the return on assets. And the reason for this is that the input variables from the lasso method yield a slightly better performance on, or it yields lower credit spreads offered to good customers compared to the wrapper method, without the cost of also giving lower credit spreads to bad customers. So it captures more of the good without capturing more of the bad customers. And this net effect gives the bank using the lasso method better models than the one using the wrapper method. So finally, my conclusions, or our conclusions, we suggest that you, instead of choosing input variables from popular models typically derived in other markets and other times, instead of that, you should rather let the data guide you on what input variables to use. And we suggest to use feature selection methods, in particular, like in an initial stage of your model development, because you also have to see on the economic interpretations of those chosen. We find that the best performance is achieved when using the lasso method, and we also confirm the superiority of the lasso method in a simulation study. We have given some insights in the input variables for privately held SMEs or models for such companies. And in particular, since this is developed from a Norwegian data set, we offer an improved bankruptcy prediction model to the benchmark model used by the Central Bank of Norway and the Norwegian financial regulatory authorities. So thank you for your time. I'm looking forward to discussions and questions.
Wonderful. Thanks so much, Ronik. So we're running a bit short now, so I have 5 minutes left for the discussion. So let me go a bit quickly. So thanks so much to the organizers for letting me discuss this paper. I really enjoyed reading it. And with that, let's just jump right into it. So just a summary, Ronik explained that already way better than I can. They seek to predict SME bankruptcy using machine learning, and they try to figure out which feature selection model works best, and which features does the best feature selection model pick. So the motivation is to discipline a little bit the zoo of bankruptcy predictors, so speaking, in the literature out there. And the results are there is impressive in and out of sample performance that seems to improve bankruptcy prediction quite a lot. And lasso regressions in conjunction with neural networks work best. Contribution is, it helps us to assess the stability and the predictive power of features and feature selection bankruptcy prediction models. All right, so the strength of the paper, really enjoyed, I really like the assessment of the feature selection, as it really helps us to get a sense of the stability of the model, right? So it kind of helps us to better assess the robustness and trust the results more. I thought that was very nice. Paper is very rigorously executed. There's impressive forecasting improvements in and out of sample performance. There's a promising technique bearing the potential to save computational costs when using it as a precursor for more computationally expensive methods, for example, neural networks. It's very well written and very well structured. It's very visually appealing because it uses a lot of plots, and the plots are very insightful, which I liked a lot. So let's move to my comments. So one thing I was thinking about was maybe you could align your motivation a bit better with the empirics. So here's how you start. the choice of input variables used for bankruptcy prediction is often ad hoc and still actively debated among both academics and practitioners. But then you go on and you derive bankruptcy prediction models from a set of 155 input variables used in previous research. So I understand that you're using these feature selection models, but you also implicitly chose these 155 variables. And maybe, you know, like one of the issues with machine learning and algorithms in general is they are extremely flexible. So there's the threat of overfitting. So do these 155 variables really make economic sense? Many seem to capture the same thing, right? Can you use maybe a theoretical structure to discipline your feature selection a little bit? And what do I mean by that? Well, let's look at your 10 highlight features here. So for example, if we take the first one and the second one, I mean, they are the same thing, really. Like the one is an indicator for whether you have positive retained earnings, and the other one is kind of an indicator whether you have very negative retained earnings, right? So they're very similar. Or then net income here, either scaled by paid-in capital or total assets, total liabilities plus paid-in capital. So like the one omits liabilities, I understand that, but they're very similar, right? Here another one, accounts payable over total assets and accounts payable over current liabilities. Okay, I see you have the scalar here. It's different, but again, very similar. And then current liabilities minus short-term liquidity over total assets, and then short-term liquidity over current assets, similar again, right? So what is really like the economic intuition here? Can you maybe get to something where you can discipline a bit your input variables? And then also another thing here, I was a bit confused about all these different scalars. Like sometimes it's total assets, sometimes it's current liabilities, sometimes it's current assets, sometimes it's paid in capital. Can you bring in a bit of consistency to make it a bit more interpretable? Then I was wondering what the target audience of the paper might be. So if it's practitioners, in that case, it might make sense to make the paper more about implementing the best model rather than kind of searching for, let's say, the true model here. If it's academics, what do we really learn then about bankruptcy from your paper? That's something we have to ask ourselves, right? Can we maybe can we use your results somehow to get closer to the understanding of the underlying mechanism that is going on? Can you maybe examine more why the features in your model that your model selected predict bankruptcy, right? So like what is really the causal mechanism that is going on here if you want to look at it from an academic perspective? Then also with the connection to prior research, one of the goals of the paper appears to be to find which of the prior papers use the best set of variables. But there's an issue here because your sample is very specific. You look at Norwegian SMEs, while most of these prior papers use CompuStat. So to find the best set of variables, would you not want to use the same data as these prior papers did to be comparable? How can you be confident that your results generalize to these other samples? Then the assessment of economic magnitude here. So when we look at your simulation results, we have very impressive economic magnitudes, right? So we have an increase in bank profit of at least 229%. Well, so this is very large, right? So like first, it's a bit unclear to me why you need to simulate here. Can you just take basically your model to actual data and then try to assess how much banks could have saved in losses if they had used your algorithm instead? So I understand there's this other paper that does that, but you know, from your paper, it was a bit unclear to me why you would even need to go there. Why can't you just look at real data rather than simulate? And then also, are the results reasonable? Because an increase in bank profits of at least 229% seems extremely large to me. Is that plausible? Then why not take your model to another sample and estimate the magnitude? It's related to the first point. So perfect. We are pretty much on time. Thank you so much for your attention.
Thank you, Dr. Rubins. Very good comments. I will not use the audience time here. I'll send you an email after the conference. Thank you very much.
Thank you. I appreciate that.
All right. So thanks to Kevin for his very accurate timekeeping, and thanks to all the presenters and discussants for a wonderful session.